Hi, everybody. Today we're going to talk about project evaluation. So what do I mean by that? Well, what we've done so far is we've thought about the cash flows to an entire company. So when you value Mercury, in the case study, you're valuing the entire company. When we've used financial statements, income statements and balance sheets to forecast free cash flows, those accounting statements are for the entire company, right? With project evaluation, we're looking at smaller things now. We're looking at projects within a bigger company. This is going to be, in your career, this is going to be most of what you're doing, right? You're not going to, unless you're an equity analyst, you're not going to be valuing the entire company's cash flows. You're going to be more interested in what you're working on today, what your project is going to generate in the future. So if you're the CFO or you're a VP or a brand manager or whatever, you're not looking at the entire company, you're looking at individual investments. So how does that change things? Most of the free cash flow calculations that we do is going to be the same. However, we're going to have to focus on incremental cash flows now. What does that mean? Well, in short, if you take the project, how do the cash flows for the firm change as opposed to not taking the project, right? That's the incremental cash flow. How much do things move by taking the project? That's all we're interested in. Then we'll do a bunch of examples after we talk about these principles for the incremental cash flows. The free cash flow equation is the same as before, right? Free cash flows are equal to EBIT times 1 minus T plus depreciation minus CAPX minus increases in net working capital. That's all the same. We're going to apply that. We're going to take that same formula and use it for individual projects rather than the entire firm. So the steps are the same, the calculations are the same, but we recognize that projects are not self-contained anymore. It's one project within a larger company, so that project may have effect on other parts of the business. And so what we need to do is we need to value the project's effect on the overall firm value. So how do we do that? We're going to focus on incremental cash flows. How much do the cash flows of the company change when you take a project, right? That's all that matters now. This is in contrast to what some accountants may want to do, or what they do, in fact. So for example, companies have overhead costs. So things like information technology. You need to have an IT department that's going to troubleshoot when people have problems. You need to have a human resources division or something like that to manage personnel issues and legal issues, right? So you need to have these fixed things that support the entire company. Now, accountants are going to take those expenses and they're going to allocate them to different parts of the business. Right, so if you're in a company that has multiple divisions, the IT expenses and the HR expenses may be allocated to particular divisions. Now that's just an accounting allocation. It doesn't mean that you're actually spending more money on IT just because the accountants assign some expenses to your division, right? So that kind of accounting issue is irrelevant for us, right? We just care about incremental cash flows. If the overhead is something that the company's going to have to pay for anyways, then it's not incremental, so we don't care about it. So let's go through an example of this accounting issue. You're going to work at a large conglomerate with many different divisions. And let's say you're a VP and you're thinking of launching a new division to produce widgets, right? Widgets, I don't know what those are. These are just kind of the standard economic example of things that you produce that are kind of easy to make. Okay, so when you make this stuff, the revenue will be $100, and the actual cost, the physical cost of making the widgets, will be $80 annually. Then finally, we have this accounting issue where the conglomerate has to allocate IT expenses to each division. So if you start a new division, some of that expense is going to be allocated to you in your division's books. In particular, $10 of the IT expenses will be allocated to your new division. Now note that you don't need to actually hire any new IT professionals. You don't need to buy any new software. You don't need to spend any money on this stuff because the widgets are just, by assumption, very easy to make. So when you do your free cash flow forecasts here, when you do this, you need to have an EBIT. what EBIT should you make? What EBIT should you use for your forecast? Well, there's basically two possible answers. We know that the EBIT is revenues minus your expenses. What are our revenues here? Well, that's given as $100. What are our expenses? Well, we've got the COGS, right? The cost of goods sold, the cost of making the widgets itself will be $80 annually. And then we also have this SG&A expense for information technology. We've got a $10 expense here. So what would be your EBIT, your revenue minus your expenses? Well, maybe you could be tricked into thinking that your EBIT should be 100 minus 80 minus 10 to give you an EBIT of $10. But that would be incorrect. The reason is this $10 expense for IT, that's not actually an incremental expense. The company is going to pay for the IT department no matter what. The accountants are just divvying up that expense across your divisions. So the incremental profit from your widget division is going to be 20. Okay. The IT expense is not incremental, so we're going to ignore it. Okay. So this is one example where it may come up. We've got a few other rules to think about when we're honing in on the incremental cash flow. These first three bullets are the new ones. Okay. These bottom three are run-of-the-mill. This is what we've been doing. So I want to focus on these first three. The first is we're going to exclude sunk costs. Now you may recall from your econ lectures. If I pull up the whiteboard here. The definition of a sunk cost is a cost that you've already paid and you can't get back. Right? It's sunk, it's gone. Right? There's nothing you can do that's going to get it back. So you may as well ignore it. There's nothing you can do about it. Okay. So it shouldn't affect your decisions going forward if it's already sunk. Okay. The next idea is one of opportunity costs. And opportunity costs, again, if you think back to your economics, kind of intro economic course, an opportunity cost is what you give up when you take a project. When you make one decision, you're giving up other options. So for example, if you've got two projects, say you're working at this company, you've got two choices. I can take project A or I can take project B. Now it could be that both of them are good. Both of them have positive NPV. Both A and B are good projects. But you only have the time to take one or the other. You can't take both. That would spread your resources too thin. You have to take either A or B. If you take A, then what's your opportunity cost? Well, what are you giving up? You're giving up B. They're both good projects, both positive NPV. So you care about what the next best thing is that you could be doing. If I take A, I can't take B. So I need to recognize that by taking A, I'm foregoing any NPV that I could get from B. So that's something that shows up in a firm because workers are limited, CFOs are limited. You can't take on an infinite number of projects. Your time and attention is finite. So you have to allocate based on the opportunity cost. Okay. And then the last idea here is one of spillovers / side effects. It means kind of the same thing, externalities. If you take project A, it could affect existing projects. So when you evaluate that new project, you have to consider what effect it's going to have on your existing products. And it could be good or bad. If I take a new project, it could draw in sales from the existing stuff, right? If I launch some kind of advertising campaign for one product, maybe that feeds over and then helps sales on another product. That's possible. Or it could go the other way. It could be that when I try to promote one product that I have, that eats into the sales from other products, because if everyone's attention is on product A, then they're not focusing on product B. Okay, and so I don't want to pretend that all of the cash flows going to project A are new, because if some of those sales are coming from project B, then that's something very relevant for me to think about. Okay. So these are the 3 new concepts when we are evaluating individual projects that we haven't had to worry about much before when we were evaluating the entire firm. These last 3 bullet points, these are nothing new, right? When we calculate the free cash flows here, we said that this is the cash flow from the operation of a company, so we were excluding any kind of financing, right? EBIT, for example, is before interest. We're excluding interest expense. We saw that net working capital, these are for operating assets and liabilities. We're excluding anything with financing. So we're still doing that when we evaluate projects, just like we did when we evaluated a firm. Likewise, we're going to include that change in net working capital as always. Likewise, we're going to include salvage value and net working capital recovery when the project has a finite life. We were doing this before, but these issues are going to become more important when we think about individual projects, simply because individual projects are more likely to have a finite life than an entire company. So we'll review this bullet point a little bit more. So let's go through these ideas again. We're going to go through these kind of rules, these incremental rules, one by one here. So what's a sunk cost? We already defined it. This is a cost that you've paid and you can't get back. The intuition is, well, the impulse you may have is that we've come so far, we've invested so much in the project, we have to keep going. Okay. But just because you've come so far doesn't mean that you should keep going. Right? You shouldn't throw money at a bad project if the project is a lemon, it's a dud, right? You shouldn't continue to sink money into something that's not going to earn a return. Okay. When we say that you've come so far, that means you've paid a lot, but if you can't get it back, then you should just ignore it. It shouldn't affect your decision. Okay, so one way to make this concrete is to think about football, right? At UH, we go to football games here, we promote the Cougars. Imagine you buy a football ticket before the season began. Okay, but now, suppose a variety of things happen. Maybe the team is not as good as you thought they were. The weather is miserable. There's this virus, and now no one's going to go to the game. None of your friends are going to go to the game anyways. Do you still go to the game anyway because you paid good money for the ticket? Or you bought these things in the spring before you knew any of this stuff was going to happen, especially you didn't know what the weather was going to be like months into the future. So do you go to the game because you paid a lot of money for the ticket? The economist would say that's irrelevant, right? Just because you paid that much money to go to the game shouldn't affect your decision today. What should drive your decision today? Well, suppose this ticket costs you nothing. Right? Then should you go? Right? You already bought the ticket. You already have it. So in principle, it doesn't cost you anything to go because you already have the ticket. So that should be your benchmark. You shouldn't be thinking about how much I paid in the past. That's irrelevant. What's relevant to you is the decision today. What could I be doing besides going to the football game? Is anything else better than going to the football game? Then I should do it. That's sunk costs. We're going to extend this to think about opportunity costs. We said the opportunity costs are what you give up. So just because a project has a positive NPV, that doesn't mean that you should automatically take it. If taking a positive NPV project precludes you, it prevents you from taking another project with a higher NPV, then you should take that higher NPV project, right? That would be the opportunity cost. If you can't do everything you want, then it becomes very important to know what the next best thing is that you could be doing with your time, with your investment. So let's adapt this to the football game. Suppose you have this ticket, you paid good money for it back in the spring, but now all sorts of things changed. What should be your decision criteria if you can scalp the tickets? Right, so scalping means you resell them, right? You have the ticket in your hand, you could go to the game, or you could sell to somebody else who wants to go to a game. How does this possibility affect your decision? Well, if you go to the game, then you can't scalp it. You can't scalp a ticket, right? These are mutually exclusive. If I scalp a ticket, I can't go to the game. If I go to the game, I can't scalp the ticket, right? So what's the decision? When should I go to the game or not? Depends on how much you can sell the ticket for, right? So the way to ask this would be, if I had to pay money to go to the game, and in fact, if I had to pay as much as I could sell the ticket for, would I go then? Because that's your opportunity cost. How much can I get from selling the ticket? That's what I'm giving up by going to the game. So effectively, that's the price for me. That's what I care about. Finally, we'll talk about spillovers. Sometimes they're called externalities, erosion, cannibalism. These are all synonyms for the same thing. If one product causes existing customers to demand less of other products, then that needs to be factored into your forecasts. So, very silly example, Halloween's on the brain here. Hershey's is a candy company. They're introducing a new peanut butter candy bar. Okay, and they're expecting to get 2 million units, blah, blah, blah. Hershey's also sells peanut butter cups. Okay, so their new thing is peanut butter bars, but they also sell peanut butter cups. And if you introduce this peanut butter bar, you know that your sales of the peanut butter cups is going to go down by 250,000 units here. So what should Hershey do? Well, they need to incorporate that, right? You can't pretend that this $2 million in sales of the peanut butter bars is the only thing going on. We need to subtract from that the $250,000 or 250,000 reduction in the units from the peanut butter cups when you're making your forecast. And we call this a negative spillover or cannibalization. So let's go through one more example, try to think through different components of a project and see which of these are relevant. Which of these should you care about if you're a manager? IKEA, they're a furniture company, right, from Sweden. They're all over now. They're deciding whether they should build a new office space. Now, IKEA already owns the land on which it wishes to build. They have 2 buildings on the property. So if they want to build a new office space, they would have to demolish those 2 buildings before they can put in the new office space. Below are 5 cash flows. Which of these are relevant to IKEA when they're making their decision? Which of these should IKEA include in their NPV analysis? Okay. So the first one, the demolition and the site clearance costs. Is that something IKEA should worry about when they're building their new office? Yes, right. You can't build the new office unless you demolish the 2 buildings that are there. Right? You would have to tear those down to build the office space. So that's an incremental cash flow. That becomes relevant. The second point, what about the cost of an access road put in last year? Well, what would that be an example of? That's a sunk cost, right? You put in the access road last year, and you can't like sell it. You can't you can't get the construction company to give you the money back if they push the dirt back over the road or whatever, right? There's no way that you can get the money back from building that access road last year. Okay, so that's totally sunk. You've already paid it. You can't get it back, so just ignore it. The second point here is irrelevant for the decision to build a new office space. The third point, what about lost profits from other projects due to the time that management will spend implementing this project? What's that an example of? We said that looks like an opportunity cost, right? If the CEO and the CFO and all the VPs are thinking about building the new space, they have to hire an architect, they have to make sure that their offices look right, blah, 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 right? That's time that they can't spend on other things. Okay, so you are giving up your time and NPV, ideally, CEOs and CFOs, their time is money. They're getting paid for some reason. If they're spending their time working on bathroom fixtures or whatever in a new building, then they're losing money somewhere else. Okay, so that would be an opportunity cost to this new building, and that would be relevant. Fourth bullet point, what What about the decrease in corporate tax payments resulting from the depreciation of the new building? Okay, is that relevant? Well, yeah, that's relevant. That's, if we go back to free cash flows, obviously we care about depreciation. That's there, and that's in our EBIT, that's in this free cash flow formula. So we've always cared about that. We're going to continue caring about that with this IKEA example. Okay. All right, so just to summarize, so far, demolition is relevant. The cost of an access road that's sunk, we don't care about that. Lost profits, that's an opportunity cost. We do care about that. The decrease in corporate tax payments, we care about that as we care with any other free cash flow calculation. Okay. How about this last point? The sites and existing buildings market values. Do we care about this thing when we're making a new building? Okay. We should, right? Why? What is this an example of? Well, this is an opportunity cost as well. So if you build this new office space, what can't you do? Well, you can't sell the land that's there already, right? You can't sell these two buildings and the property that's existing there. Okay. That's your next best option, right? That could be your next best option. If I don't build this new office space, what else could I do? Well, I could just sell these things wholesale. Okay. So we do care about that. Maybe you could sell those two buildings for more than the value of the new headquarters, in which case you should do that instead of building the new headquarters. Okay. I want to revisit this middle example here, the lost profits on other projects due to time that management will spend implementing this project. We said, well, that's an example of opportunity cost, but it's also an example of something else. It's also an example of spillovers. If you're taking this new project, it could be hurting existing projects. Because the CEO has to spend so much time, the managers have to spend so much time on this new building, that could be distracting them from other stuff, and it would be affecting those things. Okay. So you can think of this as both an opportunity cost. If I'm focusing on the new building, maybe I'm not taking other good projects, but it's also a fact of spillovers. If I take this new building, then I'm spending less time on the existing stuff that I should be working on. And so that's something that you care about as well. Moving on, when we think about projects, they usually have a finite horizon. Companies exist kind of indefinitely, but projects have a horizon. So how far out should we be thinking about for a project? The short answer is the economic lifetime of a project. Fleshing that out a little bit more, that means that till such times as future cash flows are unimportant in present value terms. Okay, so you need to forecast things out until it becomes kind of marginal and not very important for your company's valuation. This often shows up as salvage value. Sometimes it's called scrap value. Accountants may have kind of different words for it. The idea here is at the end of a project, you sell stuff. You sell whatever you have left over when you're done with it. And that's a relevant cash flow to you. And that would be the end, right? If you sell it all, then you know that there's no more cash flows coming from that project. So that would be kind of the end of your horizon. So what would be the cash flow consequences of this? Well, we've seen this example before. If you sell something, what's the cash flow? Well, you get the sale price, that's the starting point. But then you also have to pay taxes on any gains from the sale. Okay. So the gain, the accounting gain, would be the sale price minus the book value from the asset that you sold. You have to pay taxes on this gain, so you multiply it by your tax rate. Okay. So the second term here is the taxes you pay as a result of the sale. You subtract those taxes from the actual sale price itself, okay, to get your cash flow. Sometimes it's reverse CAPX. Instead of buying stuff, you're selling it. So if ExxonMobil is planning on drilling 10 new wells in an oil field, you're going to operate them for 10 years and then sell them off to a small operator. This is something that could happen. How should Exxon treat this sale? Well, you forecast the cash flows for those 10 years, but then you also have to incorporate the salvage value. When you sell it in year 10, you're going to get cash flow back from that. So those are the big ideas. Those are going to show up over and over again with projects. Next, I want to do just a lot of examples so that we're comfortable working with free cash flows. We'll start with an example on depreciation. So if you look at the old exams, you'll see about half the old exams have an example using CAPX and depreciation. The other half have examples using net working capital. Okay, so we'll start with the CAPX plus depreciation project example. In this case, your firm is producing titanium road bikes. Okay, you're considering welding stations, right? That's the new investment. 10 new welding stations, that's going to help you produce more bikes. These stations cost $12,000 each. You expect that because of the increased production, you will increase your sales and your operating income by $50,000. Okay. Now this is just sales minus your operating expenses. This does not include depreciation. Depreciation we have to handle separately. Okay. So it's going to increase your operating revenues minus your operating expenses by $50,000 for each year that they are in use. You're going to depreciate these machines straight line for 10 years. You're only going to actually operate them for 5 years, though. You're going to sell the machines after 5 years for $6,500 each. Okay, so you are buying them for $12,000. You're going to sell them after 5 years for $6,500. You have a tax rate of 30%. You have a discount rate of 10%. The first question is, what are the cash flows for the expansion if you buy these new welding stations? And then what is the NPV? So should you take on this project or not? Like any free cash flow problem, any evaluation, you want to set up all of the individual pieces for the free cash flow. And then once you get the free cash flows, you just discount them. That's the first week stuff. Okay, so let me pull up the whiteboard here. I'm just going to copy the problem onto the Word document. So we'll be able to write out some things here, but then I also want to bring up Excel because Excel is going to be a little bit easier to work through the actual numbers. Okay. So remember our free cash flow formula. The free cash flow is EBIT times 1 minus T plus depreciation minus CAPX and then minus increases in net working capital. In this example, it's a depreciation plus CAPX example. So there's no net working capital. If you look through here, there's nothing here about inventory. There's nothing here about accounts payable or accounts receivable. So in this case, we can ignore net working capital. We still have to work through all the other pieces. Okay. Now, what is EBIT? Remember that EBIT is your operating revenues minus your operating expenses, so things like your cost of goods sold, minus any administrative expenses, your sales and general and administrative expenses, SG&A, but then also minus depreciation. Right? So that's part of your EBIT. What's going on with our EBIT in this example? Well, you're going to increase your sales by $50,000. Your operating income is going to go up by $50,000, but that does not include depreciation. Okay, so we can't quite get to EBIT until we know what our depreciation is going to be. So let's start at the simplest thing. Let's start at depreciation. That you know that these machines cost $12,000. You know that they're going to be depreciated straight line over 10 years. Okay. And further, you know that you're buying 10 of these machines. Okay. So what's going to be happening to depreciation each year? Well, how much did you buy? If you buy these things now, you're buying 10 of them at $12,000 each. So you're paying $120,000 for these machines. And you're going to depreciate them straight line over 10 years. So that means that each year you're going to have a $12,000 depreciation expense. Okay, so let's work through the formula here. Everything wraps up in 5 years, so I'm going to draw out the cash flows from years 0 to 5. Right, you're going to sell these things in 5 years, so then we're done. Okay. We need to walk through our free cash flow formula. We need to get EBIT. We need to get EBIT times 1 minus T. We need to get depreciation and CAPX, And then we said net working capital, we're going to ignore this for the current problem. Put all this together to get the free cash flow. So the depreciation we just solved for this is going to be $12,000 per year for as long as we have the welding machines. One thing to remember is that you don't depreciate when you buy the assets. So you buy things today at time 0. There shouldn't be any expenses at time 0. Let me write that as a reminder. Any revenues that you are going to generate take time to generate. So if I'm making the purchase today, I just buy the machines today, there's not going to be any revenues that I generate from that purchase. Likewise, there's not going to be any expenses that accrue from operating these things. I just bought them today, time 0. There's no time for the stuff to accrue. So right away, we'll know that depreciation today should be 0. I just bought it. Likewise, EBIT and EBIT times 1 minus T should be 0. You just bought the thing. It didn't have any time to generate any EBIT. Okay. What about CAPX now? If we're focusing on time 0, what did we do with CAPX? Well, we bought a bunch of new machines. We bought 10 of these machines for $12,000 each. So that's a CAPX of $120,000. Okay, that happened today, right? If we buy these things, that's a check that we're writing. That's cash flow out of our hands for $120,000. Net working capital, there's no such net working capital in this example, so we're going to have zeros. So what's our free cash flow today? Well, we're just going to walk through our formula. EBIT times 1 minus T plus depreciation minus CAPX minus increase in net working capital. So I'm just going to write that. I'm just going to put that into Excel. I'm going to write the formula out, equal sign, so Excel knows it's a formula. What's our EBIT times 1 minus T? Well, that's 0. Add back depreciation. Well, that's also 0 at time 0. Then we subtract off CAPX, which is the 120, and then we subtract off net working capital, which is 0, or the change in net working capital, which we're going to ignore. So that gives us a free cash flow at time 0 of minus 120,000. So time 0 in these type of problems is relatively straightforward. All you're doing is you're buying the welding stations. Okay. And that's it. Now what happens going forward is these things are going to be generating sales and expenses. We saw that depreciation is kind of the easiest thing to tackle next. Straight line depreciation is kind of trivial to calculate. You just divide the asset value of 12,000, you just divide that by 10. So you're depreciating each machine by $1,200 each year, and you got 12 of these or 10 of these machines. So that's $12,000 per year in depreciation expense. Okay, and that happens as long as you own the machines, and you're going to own them all the way out to time 5. At time 5, you'll sell it, but until time 5, you'll depreciate it $12,000 per year. The next thing we should think about is EBIT. We have most of EBIT already. We know that our operating revenues minus our operating expenses is $50,000, but this does not include depreciation. EBIT does include depreciation. So we need to take that $50,000 and also subtract off depreciation. We get $38,000 in incremental EBIT because of this purchase. Again, that happens as long as we own the machines out to time 5. So what's EBIT times 1 minus T? Well, it's our EBIT times 1 minus our tax rate, and our tax rate is given at 30%. Okay, so you get about $26,000 and $26,600 each year in your NOPLATs, right? Your net operating profit less adjusted taxes. So we're almost there. We can take this free cash flow formula and we can bring that out. That's going to tell us that our free cash flows each year is going to be our EBIT times 1 minus T plus depreciation of the $12,000. So we'll get 38.6 each year for 5 years. We're missing one thing, however, and this is the kind of the tricky part of the problem. We're missing the sale of the machines. You're expecting to sell the machines for $6,500 at time 5. Recall how we handle this. When you sell something, what's the cash flow that gets generated? Well, you get the sale price, but then you have to pay taxes on any gain from the sale. What's the gain? Well, it's an accounting gain, right? The profit is an accounting number. It's how much did you sell it for minus what was it worth on your books. So we need to make sure that we know the book value of the machine before we can figure out how much we're going to actually get from the sale. So what I'm going to do is I'm going to take this table here and I'm going to add an extra row. I'm going to add a row, say between, let's just add it to the bottom here. We don't care about this net working capital, but we do care about the book value of the welding stations. Just call it PP&E in this case, just kind of more generic. We need to know what this thing is going to be when we sell it at time 5. How can we do that? Well, what should be the book value of those machines when you buy them? We talked about historical balance sheets a couple lectures ago. Well, when you buy something, all the accountant is doing is looking at the receipt. So how much did you pay for it? That's how much it goes on the books for. How much did we pay for these welding machines? Well, we paid $120,000 for them. We bought 10 for $12,000 each. So that's how much they go on our books. That's what our receipt says. So that's what happens on our books. The book value starts at $120,000. Now what happens over time is we had this thing called depreciation, right? We said that we're depreciating this straight line. So every year, the book value is losing 10%. You're depreciating a straight line over 10 years. So the book value at time 1 is going to be the book value at time 0 minus the depreciation expense. It's going to be $108,000. Okay. And then we can fill this over. So every year, the book value is dropping by $12,000, $12,000, $12,000. Until at time 5, when we finally sell it, it's only worth $60,000. That should, you should be able to do a quick mental check there. If you're depreciating it straight line for 10 years, then that means after 5 years, it will be worth half as much as when you bought it. So you bought it for $120,000, you've cut half the value off, it should go down to $60,000 when you're halfway through this straight line depreciation process. Okay. So now back to our free cash flow from the sale. We know we have to keep track of the book value to get this free cash flow from the sale. In our example, we know that we're selling it for $6,500 each, and there's 10 of them. So we're going to be getting $65,000 in proceeds from the sale. We have a 30% tax rate. Again, $65,000 proceeds from the sale. And what's the book value of these machines when we actually sell? When we go over here, we just did all this work to figure out that the book value is $60,000 when we sell it. So that means we've made a profit, an accounting profit on the sale. That means we have to pay taxes on that profit. At a 30% tax rate, we have to pay $1,500 in taxes. Right? We have $5,000 in gains here. 30% of that is going to be $1,500. So how much do we get to keep? We don't get to keep the whole $6,500. We only get to keep $63,500. What am I going to do with this $63,500? A little note here. we're selling PP&E. This is a reverse CAPX. When we bought the stuff, that was a positive CAPX. We're buying new machinery. When we sell it, it's like a negative CAPX. It's doing the exact opposite. So where we bought things for $120,000, now we're selling things, and that's going to have a cash flow effect of $63,500. Notice that this increases your free cash flow. Right before, the free cash flow was $38,600, but when I put in this reverse CAPX, the free cash flows jumped to $102,100. That's because you're selling stuff, so it's a positive cash flow for you're bringing money back into the company. Okay, so that should cover everything. We have the purchase, the depreciation, and we've been keeping track of the EBIT over time. So that's all of the free cash flows for this problem. The only thing left is to value them. Okay, what is the NPV for this? We use a discount rate of 10%. Okay. So I'm going to have an extra row here for the present value of the free cash flows. You're going to take the free cash flows and just apply the present value formula. You're going to discount each by 10%, and you have to bring it back to the present. So all I've entered here is the present value formula. Oops. Okay. This is the present value formula, C over 1 plus R to the T. What's C? Well, I'm telling Excel to pull the free cash flow from row 11, B11. R is 10%. What's the time period? Well, I'm pulling that from row 2. Okay, so I tell Excel, look in B2 for that. Okay. And I just fill this over to get the present value of each individual cash flow, and then put it all together to get the NPV of the investment. Sum up all of those present values, you'll get a NPV of $65,752. And this is all obviously worked out in the slides. I put it up. The format here is actually slightly different than what you may see or what we've just did. What this example is doing, it's obviously getting the same number. The cash flows are going to be the same. You have to track the book values. All of this stuff is the same. What may be a little bit different that you haven't seen before is when they're calculating the free cash flows, they're not using EBIT anymore. In this example, from this textbook example I grabbed, they have the operating revenues minus operating expenses first, and then they're explicitly adding the tax rate times the depreciation. Right? This is that thing called the depreciation tax shield. They're taking the depreciation out of EBIT and writing it by itself as a depreciation tax shield. So sometimes you'll see this in some books. It's the exact same thing as what we're doing. This is just a reminder that you can rewrite EBIT times 1 minus T. That's the same thing as your operating revenues minus your operating expenses minus your depreciation times 1 minus T. And if you add depreciation to this thing, then you can combine like terms. So EBIT times 1 minus T plus depreciation, what we'll do is we'll pull the depreciation out from the EBIT bracket, and we'll be left with operating revenues minus operating expenses times 1 minus T minus depreciation plus T times depreciation, and then plus depreciation. So you'll see that this minus depreciation cancels out with that plus depreciation. We're just combining like terms here. All we're left with is this depreciation tax shield here. So we saw this when we first covered free cash flows. Sometimes when you see examples that will work through the depreciation tax shield by itself outside of EBIT. So that's what this example is doing. It's exactly equivalent to what we did in our spreadsheet, where we took EBIT times 1 minus T plus depreciation We just had depreciation kind of hiding in two places. We had it here and we had it in there. Okay. Next, I'm going to switch and talk about working capital. So again, about half of exam problems are like this CAPX plus depreciation. The other half are going to be like a working capital example. We're going to do three types of working capital examples. In the first case, we'll do inventory here, and then we'll do a accounts receivable example and a accounts payable example. Just so you get used to this, we know that working capital is the trickiest component of free cash flows, just because you've got all these different moving pieces, this differences and difference thing going on. So we're going to do extra problems to try to help us with that. Okay. Here, you're going to run a chain of stores selling sweaters. Okay, pretty simple product. You're going to buy sweaters to begin with. You're going to buy 1 million sweaters, and you're going to pay $30 for each one. That's your initial inventory, right? So it's an inventory example. You're going to sell 500,000 of those at time 1. You're going to sell them for $60 each. And at time 2, you're going to sell the rest, the other $500,000, you're going to sell those at $60 each as well. Okay, we have a tax rate of 40%. What are your after-tax cash flows? All right, so what's going on here? The sales are pretty simple, but all you have to do is keep track of the inventory. Okay, you start with 1 million sweaters. You sell some at time 1, you sell the rest at time 2. We want to see how this working capital feeds into our free cash flow calculation. Okay. So I'm going to pull this up here. I just wrote out the text. We can do a little bit of work on the whiteboard, and we can also write it up in Excel to do the free cash flows for us. Okay. In this working capital example, you notice we don't have any kind of CAPX or anything. We don't have any depreciation. There's no big, no kind of long-lived plant property and equipment or anything like that. So we're going to be able to focus on just a couple pieces of the free cash flow formula. Okay, we'll set up the time. We need to have EBIT. EBIT times 1 minus T. Depreciation. We're gonna have no depreciation in this case. Sweaters don't depreciate, right? They're short-term assets. Inventory is short-term, so we don't have to worry about depreciating them. CAPX, likewise, we don't have any CAPX. We will need to worry about increases in net working capital. That's the last part of our free cash flow calculation. Okay, so just like before, what is the free cash flow? It's going to be the EBIT times 1 minus T plus the depreciation minus CAPX and then minus any change in net working capital. Okay, so I'm just setting up the formula for now, and we'll fill out these details later. Okay, we're not going to have any depreciation in this example, so just right away I'm going to mark it as 0. Likewise, no CAPX, just mark it all as 0. Okay. Let's think about EBIT. We know that EBIT are our operating revenues minus our operating expenses minus our depreciation. We know that there's no depreciation, so all we have to worry about are operating revenues and expenses. What's happening at time 0? Just like in the last example, at time 0, you're just buying the stuff. In the last example, you were buying these welding machines. In this example, you're just buying the sweaters at time 0. Okay, that's it. So you're not selling the sweaters, you're not expensing the sweaters, you just bought them, that's it. So your revenues and your expenses at time 0 should be 0. Okay, this is going to generally be true because you need time to generate revenues or expenses. So you're not going to generate anything at time 0. Okay. What happens going forward? What happens to your EBIT going forward? Well, let's say at time 1, you sell 500,000 sweaters for $60, and you know that you bought them at $30 each. Excuse me. You bought them for $30, so that's your expenses, $30 per sweater, and your revenue is $60 per sweater. So your EBIT at time 1 is going to be your revenues minus your expenses. You're selling them for $60, you're expensing $30 that you paid for it, and you sell 500,000 of them, $500,000. Okay. So that's going to be $15 million in profit. $30 times 500,000, $500,000. So 30 times half is $15 million in EBIT at time 1. And likewise, at time 2, you're doing the same exact thing. You're selling $60 sweaters that you bought for $30, and you're selling 500,000 of them. So again, your profit should be $15 million at time 2. All right, so I'm just going to fill that in our spreadsheet. And then nothing happens at time 3. We're just 2 periods. That's it. What's our EBIT times 1 minus T then? Well, we've got EBIT of 15, and we multiply it by 1 minus our tax rate of 40%. So we have $9 million in no plat, $9 million in after-tax profit. All right. So we're working along our formula. We got our no plat down. Depreciation and CAPX in this example, we just assumed away. We need to deal with this increase in net working capital before we can calculate our free cash flow correctly. What happens to our net working capital? Well, net working capital, remember, are your operating current assets minus your operating current liabilities. In this case, we only have one such account. We just have our inventory, our sweater inventory. That's it. We don't have any other accounts payable, accounts receivable, anything else that would show up here. No prepaid expenses or whatever. We only have one account, inventory. Okay. So I'm going to write an inventory account down separately. We need to keep track of this balance over time. So how many sweaters did we have yesterday? Well, we didn't have any of these sweaters. We just bought them today. So our starting balance for the inventory from yesterday is 0. What happened today? At time 0, we bought 1 million sweaters for $30 each. So that means there's $30 million in inventory today. Right when you buy it, you get $30 million worth of sweaters. So what was the increase? Well, it ended at 30 and it started at 0. So the increase today was a $30 million increase in net working capital. Nothing else happened. We couldn't sell anything right away at time 0. So the only cash flow effect was that purchase of the sweaters. That's all we did at time 0. Now what happens at time 1? Well, we sell half of those sweaters. So what happens to our inventory balance? Well, it was $30 million to begin with, but we sold half, so now we're down to 15. Likewise, what happens at time 2? Well, we sell the rest of the sweaters, so we go from 15 down to 0. How does our net working capital change? What does it change each year? Well, we bought 30 at time 0, and then it's dropping 15 each period. It started at 30, it ended at 15, so that's a drop in $15 million in net working capital. Likewise, from 1 to 2, we started at 15, we ended at 0, so that's another drop in net working capital of 15. These are things that are gonna increase our cash flows. We're selling, we're extracting that money out of the operations when we sell the sweaters. Okay. So what happens to the free cash flows when we fill this formula over? We'll see $24 million in free cash flow at time 1 and 24 at time 2. Now 9 of that is coming from the no plat, and the other 15 of that is coming from the sale of the inventory, right? The reduction in the inventory. That's a positive cash flow for the company. Okay. And then if we had a discount rate, we could value these, but this question is just asking for the after-tax cash flows, so that's all we have. But you can see that the difficulty here is keeping track of the inventory and then separately calculating the increase in net working capital. And this is the thing that shows up in our free cash flow formula. It's kind of like when we did the depreciation and CAPX example, we had to keep track of the book value of our assets. The equivalent here, the analog here, is we have to keep track of the inventory balance. this is kind of like the book value that we had to track before. Now we have to keep track of the balance so that we can calculate the change in the balance. Okay. So the accounting numbers here do matter for the cash flows. All right, so that's the inventory example. Next, I want to talk about the accounts receivable example. Like inventory, accounts receivable is a current asset. Now, it's a little bit more subtle than inventory. Inventory, everyone kind of has a picture of what that looks like. You've got this stack of sweaters sitting on a shelf somewhere. Accounts receivable is the money that your customers owe you, right? Your customers bought some product, you gave them the product, but they haven't paid you for it yet. So you have a receivable. They still owe you money. Somebody owes you money. That's an account receivable. We're going to do an example here. In this case, you're running a building supplies company, and you're thinking about a new line of door fixtures to your product range. Okay, so you're going to be doing this for the next 3 years. I don't know why door fixtures, just anything you want. You expect that in each year you're going to have sales of $340,000. For the next 3 years, and your cost of goods sold, COGS, is going to be $230,000. So it costs $230,000 to make these door fixtures. You can sell them for $340,000. You expect, however, that 25% of your customers are going to take advantage of your flexible payment option and settle their account 1 year after receiving the goods. Okay. So this $340,000, you're not going to get all of that right away when you sell it. Some of your customers, 25% of them, in fact, are not going to pay you until 1 year after the sale. Okay. That's where the accounts receivable is going to show up. We have to keep track of how much people owe us. That's going to feed into our cash flows. Okay. They're all going to settle 1 year after they actually receive the goods. So we have a tax rate of 40%. What are the after-tax cash flows from this new line? Okay, let's pull up the whiteboard again. Okay, so here's the problem text. I'm gonna replace all of these numbers that we had from last time. We have a 3-year period, so I'm gonna keep this 3-year horizon here. We're gonna have to work through the EBIT times 1 minus T. Like the last inventory example, we don't have any CAPX or depreciation. These things, when I do simple examples, usually you'll either have net working capital or CAPX and depreciation. So the fact that we're doing a accounts receivable example, you don't see any kind of PP&E here. Everything that we have is kind of short-term assets, just these door fixtures. Okay. We don't have inventory. We'll have to talk about what we do have, though, but it's not inventory this time. All right. So let's think through our EBIT again. Let's start there. Let's sit at time 0. We'll start at the beginning and think about how much profit are we making today. Just like in all the other examples we've done, we're not making any profit today, right? This is a project that takes time to generate sales and expenses. So right now I'm going to decide to do it. I'm not going to generate sales today. I'm not going to have expenses today. Right? Those things both take time to accrue. So we're going to have a 0 here, just like in the past, 0 profits. And, likewise for yesterday, obviously. Okay. What happens going forward? Well, again, EBIT is going to be our operating revenues minus our operating expenses minus depreciation. What are the revenues from this project? This new line of door fixtures, we're going to increase our sales by $340,000, and we're going to have a cost of goods sold of $230,000, and there's no depreciation, no assets are getting or losing value here. So that means we're going to have a profit of $110,000 per year. Okay, so I'm going to go to the EBIT now in the table, fill out $110,000. And that happens in each of the next 2 years. Each of the next 3 years, we're getting this $110,000. So that allows us to calculate our NOPLAT. It's just going to be the EBIT times our tax rate, times 1 minus our tax rate of 40%. So each of the next 3 years, we have a no plat of 66. The tax rate is coming from here in the problem, 40%. Okay, so 60% of 110 is 66. All right, so right away, we're done with these first 3 pieces of the free cash flow equation. We need to settle on this net working capital. Again, net working capital is current assets minus current liabilities. What accounts do we have here that fits into these things? Well, we just have the accounts receivable, AR. We don't have any inventory, which would be another current asset. We don't have any accounts payable, which would be a current liability. We don't have anything like that. We just have the accounts receivable. So that's shortened as A/R. What's our account receivable yesterday? Well, we didn't do anything, so we don't have any accounts receivable now. What about at time 0? Nothing going on at time 0. We didn't make any sales at time 0, as we've reiterated. No accounts receivable. When do the accounts receivable kick in? Well, it's when we start to sell stuff. Okay, so how much do our customers owe us at time 1? Well, we sold all these door fixtures for $340,000. That should be our sale. That's our sale amount each year. However, we said that only 25% of these customers are not going to pay us right away. They're going to pay us in 1 year. So $340,000 times 0.25 is how much we're owed at time 1. So I'm going to write that in the formula here. At time 1, we made $340 in sales, and a quarter of those are still owed to us. So customers still owe us $85. How about at time 2? Well, what happens at time 2? These folks, they owe us $85, so they pay us back at time 2. Right? All the cash flows get settled after 1 year. So that 85 gets paid off, but what happens at time 2? Well, there's more sales of $340,000, and now they owe us for the $85,000 worth of stuff. Okay. Likewise, at time 3, the folks who bought at time 2 pay back what they owe us at time 3, but at time 3 we have new sales. We've got this extra $340,000 in sales at time 3, which means we've got an extra $85 worth of stuff that people owe us. Okay. Is that the end of it? Almost. What happens to this final 85? Well, eventually they pay us back. That happens at time 4. So eventually at time 4, this accounts receivable goes to 0 when all the customers pay us back. Notice that we were only selling these door fixtures for 3 years. So nothing else is going on at time 4. We stopped selling at time 3. So time 4 EBIT, no plat, etc. is just 0. But we need to keep 4 here because that's where we see a change in accounts receivable from the sales at time 3. They paid us back. We'll see this as the increase in net working capital, right? What's the increase in net working capital at time 0? Well, we didn't have any accounts receivable at time 0. We started with 0 yesterday, so we have 0 change net working capital. But moving that along, at time 1, we sold a bunch of stuff, and now we are owed $85. So we had an increase in net working capital of 85. That doesn't get reversed until time 4. At time 4, finally we get paid back, and we have a negative 85. We have a drop in our net working capital. Remember, net working capital is current assets minus current liabilities. So when our assets go down, that means that we have a negative increase in net working capital. Okay. So putting all of this together, now we have all the ingredients. We've got no plats, depreciation, CAPX, and the increase in net working capital. Just going to throw that into our free cash flow formula. No plats plus depreciation minus CAPX minus the change in net working capital. Nothing happened at time 0. That's good. Fill that over. time one is kind of interesting. We sold a lot. We made a lot of profit at time one, right? 110 in profit, but our cash flow is actually minus 19. Okay. How did that happen? Well, 25% of our customers didn't pay us back. You think that's not that big, right? 75% paid right away. But the 25 that didn't pay, that meant that the sales price wasn't paid. So this 85, that's not like 25% of your profit. That's 25% of your top level sales. So that's a big number. Okay, that is higher than your profit. Okay, even though you made a lot of profit, you get to keep $66 worth of profit because those customers didn't pay you. 25% of your customers didn't pay you up front. That's a lot of sales that you didn't get. So you actually have a negative free cash flow at time one. Okay. Time two and time three, you're just basically keeping your profit, your no plats of 66, and you're holding your accounts receivable steady. Those customers who bought at time one, they finally pay you at time two, but now you've got new customers at time two who didn't pay you, so your accounts receivable just stays level. There's no cash flow effect because you're just replacing your accounts receivable with new accounts receivable. You finally get a positive cash flow at time four. Finally, you get paid back for that minus 85 from time one. Okay. So this kind of financing scheme here where you're allowing your customers to pay you later, that can actually be pretty expensive. What it's doing is it's moving this $85 from time one, it's moving it all the way back to time four, which, as we know, has kind of important time value of money implications. So that's accounts receivable. Now I want to end with the kind of the trickiest type of example, which is the accounts payable. What's interesting about accounts payable is that it's a current liability. When we did inventory and accounts receivable, those are both assets, short-term assets. Accounts payable is the opposite of an accounts receivable. Accounts payable is you owe money. Your customers don't owe you money. Now you owe money to somebody, like a supplier. Now that's the spirit of this next example. Your supplier is going to let you kind of coast a little bit. You're not going to have to pay right away. You can delay things, and we'll see that shows up in your cash flows the same way it showed up in the accounts receivable, but now in the opposite way. Now you get a good cash flow up front because you were able to delay the payments, but you can't delay it forever. At some point, you have to make the cash flow to your supplier. Okay. In this case, pretend you work for H-E-B, and you're thinking about switching your supplier of avocados. Currently, you're buying from Calavo, but you can get a lower price from Del Rey. Okay, that's the premise of the question. These are the top two avocado suppliers. Other than that, I'm just going to make up some numbers here. Suppose H-E-B is going to sell 10 million avocados per year, and each avocado sells for $1. Again, just making this up. Currently, H-E-B pays 25 cents per avocado from Calavo, but Del Rey, this new supplier, they're offering a 3-year contract where they'll sell avocados for cheaper, for 15 cents instead of 25 cents. Okay, so this could be very tempting. You may be tempted to switch to Del Rey to buy your produce at a cheaper cost. So you tell your current supplier, Calavo, you tell them about the new supplier's offer. Now, Calavo says they're not able to sell avocados for less than 25 cents a piece. However, Calavo is going to let you delay your payments by 1 year for any avocados sold in the next 3 years. Okay. So if you switch to Del Rey, you get this 3-year contract where you can buy cheaper avocados. If you stay with Calavo, you have to pay the same price, the same 25 cents per avocado, but you can delay your payments by a year. Okay, and that's going to be beneficial. We want to weigh these things. Okay, so assume that H-E-B is going to be selling 10 million of avocados in 1 year, in 2 years, and in 3 years. $10 million or 10 million avocados each year. Further, we're going to suppose that all the other current assets and liabilities stay the same. So the inventory of avocados are not going to change here. When you sell you buy avocados and you sell them with a pretty short turnaround, so your inventory isn't going to change. The only thing that's changing is going to be this accounts payable or the EBITs, right? The profit that you're making on each sale. We have a tax rate of 30% and a discount rate of 10. Which offer should you take? Should you switch suppliers and go with Del Rey for a cheaper avocado, or should you stay with Calavo and take advantage of the better payment terms, the delayed payment? Okay. So again, let's pull up the whiteboard here. We got all the avocado information here, and then we're gonna write things up in a spreadsheet. Don't have accounts receivable anymore. We're gonna walk through these calculations. So what will be the free cash flows, say, from staying with your current supplier of Calavo? Format these just so they merge and wrap. Okay. So start at time 0. What happens at time 0? Well, in this example, nothing should be happening, right? And all the other examples, you're not selling anything at time 0. You're not buying anything. You just replace all these things with zeros. We know that. Okay. Likewise, in this example, there's no fixed assets. You're not buying any machines or anything. So CAPX and depreciation, we're going to keep those at 0. The only thing moving in this case are going to be our EBIT and our increases in net working capital. Okay, so let's think about this incremental cash flow. We talked about this idea at the beginning of the slide deck. Here we have 2 choices, right? We can't do both. We can't buy from both Calavo and Del Rey. We have to make a choice. If we choose the cheaper avocado, then we don't get the accounts payable. If we choose the accounts payable, we don't get the cheaper avocado. All right, so we need to pick one relative to the other. So what's going to be the free cash flow, the incremental free cash flow from staying with Calavo? How is that going to affect our profit? Well, our profit's basically going to go down by 10 cents per avocado. Right? You sell each avocado for $1. Let's do this if we, even if we stay with Calavo. You're selling each avocado for $1. They cost you 25 cents per avocado, so you're making a profit of 75 cents, and you're doing this 10 million times per year. Okay, so that's $7.5 million in EBIT if you stay with Calavo. What if you switch to Del Rey? Well, you're still going to sell the avocados for $1, but now you're only paying 15 cents per avocado, and you do that 10 million times per year. So we're up to 8.5 million in EBIT if we switch. Okay. So let's just get the incremental effect. If we stay with Calavo, what's happening to our EBIT? It's going down by 1 million. It's going to be 7.5 versus 8.5. So it's minus $1 million in EBIT. We're losing operating profit by staying with our current supplier. Okay, hopefully that makes sense, just because our current supplier is charging us more for the avocados. Okay. So if we look at the incremental EBIT, maybe I'll make a note of this. We're going to do this as incremental EBIT. At time 1, we're losing $1 million. And likewise, time 2 and time 3, we're losing $1 million because we could lock in a better deal for 3 years with Del Rey. So what's our NOPLAT? Well, we just multiply that by 1 minus our tax rate, where our tax rate is given at 30%. Okay, so that's just from this part of the problem here, 30% tax rate. Okay. All right, so we're almost there. We've kind of tackled 3 pieces now. The 3 easiest pieces we knocked out. Now we have to deal with the last part of the free cash flow equation, the increase in net working capital. what is our net working capital? Well, we know it's current assets minus our current liabilities. In this case, we only have one account. That's our account payable. That's a liability, so this is a negative number. Okay. The net working capital is the negative balance of our accounts payable. So I'm going to add just an extra line here. We're going to keep track of our account payable. We're going to keep track of our net working capital, and then we're going to get the increase in the net working capital. Okay. What's happening to our accounts payable? Well, we haven't sold anything at time 0. We haven't bought anything at time 0, so that's just 0. Net working capital, 0. Right. What happens at time 1? Now we bought avocados. If we stay with Calavo, we can buy the avocados from them without paying them at time 1. So what happens at time 1 to our account payable? We should be paying Calavo 25 cents for 10 million avocados. But we're not going to do that because they offer us this sweet deal to delay payments. So we have 10 million avocados times the 25 cents that we owe. That works out to $2.5 million in accounts payable at time 1. Okay. What happens at time 2 and time 3? Well, at time 2, we have to pay Calavo this 2.5 that we owed them at time 1. Okay. However, we sold another 10 million avocados at time 2, and we owe Calavo 2.5 million on those. Okay, so from time 1 to time 2, we drop our account payable by 2.5 million, but then we increase it by 2.5 million for the avocados that we haven't paid for yet. So the balance stays the same. Right? This is just like our accounts receivable example, except now it's an accounts payable. You're just replenishing the accounts every period. So time 1, time 2, time 3, we're buying from our supplier, but we're not paying them until a year later. Finally, then, this deal, remember, lasts for 3 years. You can delay your payments for 1 year for anything sold in the next 3 years. So finally, the bill comes due, right at time 4, we have to pay back for the 2.5 million that we owe from the time 3 sales. So finally, the accounts payable goes to 0. Finally, we pay off everything that we owe from this contract. Okay, so that's what's happening to the accounts payable. What's a little bit different here than in the past example is that the accounts payable is a current liability. So what's happening to the net working capital? Well, net working capital is assets minus liabilities. So the account payable is a negative. The net working capital is actually a negative 2.5 million because it's a liability. The accounts payable is a liability. So finally, we can calculate the free cash flow ingredient, the increase in net working capital. Finally, we can say, okay, we end at minus 2.5. We started at 0. So what's the increase? What's a minus 2.5? And we fill that formula over. There's no change in net working capital at time 0, nothing at time 3. We're just replenishing the accounts payable year by year. And then finally at time 4, we pay back what we owe. So that's an investment of 2.5 million, right? We had to put 2.5 million in finally at time 4 to pay back and then kind of finish the deal with Calavo. Okay. So put all this together. What is the incremental free cash flow from staying with Calavo? You have the NOPLAT, add depreciation, subtract CAPX, and then you subtract changes in net working capital. Nothing happens at time 0, that's good. Fill that over for 4 years. At time 1, we actually get a positive cash flow here. We're paying more for the avocados, which should lower our cash flow, but because we were able to delay the payment by a year, we get a positive cash flow of 1.8 here. Okay, time 2 and time 3 should make sense. This is just because we're paying more for the avocados. We're paying 10 cents more per avocado. The effect of that is minus 0.7 on our profit. And then finally, at time 4, we pay back what we owe. That's a minus 2.5. So we can put all of this together, discount it to get the present value of the deal. The cash flow, the free cash flow, and then we discount it by 1 plus the discount rate of 10% raised to the time period here. So the NPV of staying with Calavo is the sum of all of those present values. So we get an NPV of about minus 1.2. Okay, so it's not obvious that you want to switch. It turns out that you should switch, right? The NPV of staying with Calavo is minus 1.2. Therefore, switch to Del Rey. You'll pay less for the avocados, and that's worth more than this payment offset. Okay, but it's not obvious initially because you do like getting that 1.8 up front, even though it comes at a cost down the road. You do like getting that up front. So the time value of money thing was valuable, but it's not as valuable as the lower avocado costs. So therefore, we should switch to Del Rey. Okay, so you can see the accounts payable example is going to be kind of the kind of trickiest to get your head around because accounts payable is a negative thing. So your net working capital is going to be negative, which means that your increase in net working capital, you have to take differences in negative numbers, which is again a little bit trickier than usual. But if you're just very careful and you just go through the pieces one by one, you can calculate the free cash flow just like any other problem. Okay. I'd like to end with a little mini case. I will put everything together for one example, and again, just be very careful in going through it and see how it looks. All the information for this mini case is summarized in this one slide. Okay, so there's a lot here, but again, as usual, if we just take it piece by piece, we just walk through the free cash flow calculations, we'll get to the answer, right? It's just mechanical. We just have to take things slow here. Okay. In this case, you work for HP and you're thinking about building a new smartphone. The project's going to last for 6 years. We have things broken down by investments here, and then revenue and costs in the second bullet point. So how much do you have to invest? Well, you have to put in $30 million for machinery today, year 0. We're going to depreciate this stuff over 6 years using straight line depreciation as usual. There's salvage value. So at the end of this project, at 6 years in the future, you put in 30 million, you're going to get out 2.5 at the project's end. Okay, it's not all gone. You're going to get some of that back as salvage value. What else do you have to invest in? Well, just like you have to invest in long-term assets and machinery, you also have to invest in short-term assets in net working capital. So we have to invest $3 million to begin, and then we're going to increase that 4% per year. The idea is as the business grows, you need more assets to support that. Just like we can salvage the machinery, we can also salvage the net working capital. We call that net working capital recovery. We get back anything that we put in at the end of the project. Moving on to the revenue and the costs, the EBIT component here, we have $50 million in sales. I should write that as sales in year 1, growing at 10% per year. And then we have costs. We have a $30 million fixed cost. So that means every year we have to pay that $30 million. It's fixed, you can't get away from it. We also have variable costs of 30% of annual revenues. Okay, so as the revenues grow here, your variable costs are going to grow. The idea is that it costs more to make more stuff. If you're selling more product, your costs are going to go up with that. So that's everything here. We have a tax rate of 30 and a discount rate of 12. We're just going to walk through the free cash flow equation. We're going to set it up in Excel, have Excel do the work for us. But again, as long as we take it piece by piece, we can handle it. Before I forget, write revenues of 50 million in year 1. Okay, so let's dock this on the side, and we'll have the spreadsheet on the other side here. Okay. So as usual, we'll have time at the top. We'll start at yesterday. Sometimes we need to keep track of what things looked like yesterday, in particular with net working capital. This is going to go out for 6 years. Okay. Then we're going to walk through our free cash flow ingredients. So we'll need to have somewhere around here, we'll need to have EBIT, and then following that, we'll have EBIT times 1 minus T. We'll need depreciation, obviously. We'll need CAPX. And we'll need increases in net working capital. And I'm giving some extra rows in between just so we can show intermediate steps. Okay. So if we start with investments here, we'll just go top to bottom. You have to buy $30 million worth of machinery. So this is a long-term asset. You buy this at time 0. What do we call that? Well, that's CAPX. Right, so time 0, you're putting in $30 million of CAPX. Okay, we'll just do everything in millions to keep it simple. That's going to be depreciated straight line for 6 years. So say we want to keep track of the book value of this. So I'll keep that below CAPX here. Book value of the machine. We want to see how this goes down over time. Well, if it's being depreciated straight line over 6 years, then that means this 30, the initial cost, that's what it's on the books for initially. We're going to cut that down in 6 equal pieces. Okay, that's our depreciation. So we can handle the depreciation right away. We know that at time 0, there's no depreciation, right? You just bought the machinery. You shouldn't depreciate it. It takes time for these expenses to accrue. So 0 depreciation at times 0. But going forward, we know that this book value is going to get cut 6 ways. Okay, so I refer to the book value of the machine. It was 30, and we're going to cut that in 6. So we're going to have a $5 million depreciation expense every year. I'm just going to fill that over. For 6 years, we're taking a $5 million expense in depreciation. So what happens to the book value then? Well, it's dropping by 5 every year. It starts at 30, and then it drops by 5 each time. So then finally, at the end of year 6, it should be worth 0. Right? That's a useful check. If you're depreciating it straight line for 6 years, then it should go to 0 in year 6. And so that's what we get. That's the initial CAPX. That's the depreciation. We're going to sell the machinery for $2.5 million at the end of the project. Okay. So just like we did with the early example on depreciation and CAPX, now we have to worry about reversing the CAPX. Right? We're going to sell it for $2.5 million. Now remember, if I bring up a Word document here, remember what the free cash flow from a sale of an asset is. It's the sale price, free cash flow from a sale. It's the sale price minus the taxes that you pay on the sale. And the taxes is governed by the gain. So in this example, we said that you're going to sell the machinery for $2.5 million. You have to pay taxes on that. We have a tax rate is given at 30% down at the bottom, last bullet point. $2.5 million in sale price. And what's the book value Well, we just kept track of that. All we needed to know was depreciation. We looked at the book value here. We see that when we sell it in year 6, it's worth nothing on our books, right? We depreciated it all the way to 0, so the book value is 0. So that means that we're going to pay taxes of 30% on the $2.5 million proceeds. Okay, so that's 0.75 in taxes. So we're going to be left with 1.75 million in reverse CAPX when we sell this stuff. Okay, so this is a negative CAPX of minus 1.75. It's going to round to 1.8. That's this number here, the free cash flow from the sale. Okay, so that takes care of CAPX and depreciation. Okay, just like those earlier examples, we did the same basic steps. Next, we have to move on to net working capital. I'm going to move down here. Ultimately, what we need is the increase in net working capital, but you can't get the increase in net working capital without knowing the level of net working capital. So how much net working capital did we have for this project yesterday? Well, we didn't take the project yet. We didn't have the project, so we had nothing. There's 0 net working capital associated with this project yesterday. What this last bullet point under investments tells us is that net working capital is $3 million to begin. You have to put in $3 million at time 0 right when you take the project. And that's going to grow at 4% each year until the very end of the project. Okay, so I'm going to grow this $3 million. I'm going to multiply it by 1.04 every year. Okay, so it's going up 3.1, 3.2, 3.4, 3.5, 3.6. It's just growing at 4%. And then finally, at year 6, when we wrap things up, just like we're selling off this machinery, we're getting that reverse CAPX. We're also going to bring the net working capital to 0. We're going to sell the machinery. We're also going to sell the net working capital, put it to 0. That's going to allow us to calculate this increase in net working capital. It's just difference from today versus yesterday or last year. So today we have to put in 3, and then each year we fill this over. We have to put in about 0.1 million per year until the very end when we sell it all, and then we get back the 3.6 million that we put in. Okay. So here's our net working capital. That's done. Here's our increase in net working capital. That's done. Here's our CAPX. That's all done. And here's our depreciation. That's all done. So the only thing we need to do in order to finish the free cash flows is our NOPLAT, EBIT here, and then we just got to add it all up to get the free cash flows. That brings us to this bullet point on revenue and cost estimates. That's what shows up in EBIT, right? These are our income statement items. That's what shows up in our profits. So I'm just going to take this one by one. I'm just going to basically draw out the balance sheet here before we get to the EBIT. Okay, so what are our revenues going to be from this project? We're going to, again, not have any revenues at time 0. It always takes time to accrue these things. We're going to have 50 million at time 1, and that's going to grow at 10%. Okay, so how do you grow up by 10%? You tell Excel we're going to type in a formula, equal sign, 1.1 multiplied by what the revenues were last year. Okay, so I refer to the previous cell and I fill that over. So our revenues are growing at 10%, 10%, 10%. If we have the top line, we have revenues, now we need to sort out the costs. It says that there's fixed costs of 30 million. So every year, no matter how much you sell, you have to pay this 30 million. This could be something like overhead or salaries or something like that that you just can't get away from. And then there's also variable costs. These would be things like costs of goods sold. The more phones you sell, the more your expenses go up. The variable costs are going to be 30% of annual revenues. So how do we put that into Excel, well, we type in 30% and we multiply it by the revenue, which is located a couple rows up right there in that cell. So the variable cost will be 15 in year one. We'll fill that formula over. It'll be 17 in year two, 18 in year three, 20 in year four, etc. Okay, so we're almost to EBIT. What's one thing that we need to put in EBIT that we don't have up here? Well, we know that depreciation shows up in EBIT. Right? Depreciation down here, that's an ingredient for EBIT. It's not an EBITDA, because EBITDA is earnings before interest, taxes, depreciation, and amortization. But EBIT has dropped the DA, so it is no longer before depreciation, right? It's after depreciation. So we have to remember that depreciation is part of your EBIT. So putting all of the EBIT together, you have your revenues, that's your top line in your income statement. Then you subtract off your costs, your operating costs, your cost of goods sold, your SG&A, but then you also subtract off your depreciation. And I'm going to fill that formula over. So in year one, we have about $0 in EBIT because we have $50 in revenue, 30 in fixed costs, 15 in variable costs, 5 in depreciation. You add up 30 plus 15 plus 5, you get 50. So 50 minus 50 is about 0. But then going forward, our profit margins get better and our EBIT grows. Last thing, we need to take this NOPLAT. So we need to take the EBIT and multiply it by 1 minus our tax rate of 0.3. Okay, so our NOPLAT in year 6 is 15. That's 70% of 21. Okay. All right, so that gives us all of our ingredients now. We have to just add up the NOPLAT, add that to the depreciation, subtract off CAPX, and subtract off increases in net working capital to get our free cash flow. So start with NOPLAT, add depreciation, minus CAPX, minus increases in net working capital. We have minus 33 to begin with. That's minus 30 CAPX, minus 3 in net working capital. We fill that over to fill out the rest of the balance sheet. And then once we've done this, once we get the free cash flows, all that's left is to get the present value of these free cash flows. So now we're back in week one world, where we just take the cash flow, we divide it by 1 plus R, where R is given us 12%, raised to the time period. So the total value, the NPV of this whole project, is going to be the sum of all of those present values. We get about 14.6 million for the NPV here. So that looks like what we have. So in the slides, we're breaking it out into it's too much to put on one slide, so it's broken up into the NOPLAT components in our row here, and then our investments in net working capital and CAPX later. Okay, so we get that 14.63. So as you can see, with all of these problems, there looks like there's a lot of steps, and there are, but each step is pretty small. So you just have to remember how to do each individual thing, how to get the EBIT, what's in this EBIT, what's in that NOPLAT, what is depreciation, what is CAPX, how do we track the increase in net working capital, whether it's a current liability or a current asset. We need to keep track of that to see what the balance is for the net working capital and see what's changing, right? We care about the change in net working capital here. So there's all these little pieces, but if you just take it piece by piece, tackle the things that are easy first. So depreciation is usually pretty easy to handle. You tackle that thing first, and then just take what's left in small chunks. Okay. All right, so next I want to wrap up our discussion on free cash flows. So big picture, what have we done? we have this thing called the DCF method, discounted cash flow method. It's the baseline. It's what we're going to use to calculate NPV. But it is making some assumptions. In particular, when we forecast our free cash flows, it's pretty static. Right? That means that we're taking our best guess. Like in the Mercury case, for example, you're just taking your best guess what you think the free cash flows are going to be. There's not a lot of room for uncertainty or changes going forward, right? It's just one best guess. That's what we mean by static. Okay, so if you have a pretty good idea of what the cash flows will be, then that's fine. And if you don't think that the project is going to change drastically, then again, that's okay. We're going to relax these assumptions going forward, but if this is the world we're in, then what we've done so far is good. Likewise, we've had a constant discount rate. We haven't talked about where the discount rate is coming from, really. I've just given it to you because we need to think more about the discount rate going forward. We're going to be building on this. We're going to be building on this basic DCF by incorporating things like sensitivity analysis. A sensitivity analysis is a way to gauge the uncertainty of our estimates and how important those estimates, how important our assumptions are about our estimates going forward. Real options is similar in that real options deals with when you change the project. Okay, so we have this little bullet point here. If the project can change drastically, then we may want to incorporate real options into our model. And then finally, with this bullet point about the discount rate, we need to think about how the discount rate is driven by firm decisions. Okay, so these are all things that we're going to incorporate going forward. With sensitivity analysis, we said that that's this point here, we're trying to get at the uncertainty in the forecasts. We're going to be changing different assumptions. Well, we'll see this after the first midterm, but you want to change certain assumptions in your model to see how it affects your bottom line. And you want to see how sensitive, how robust rather is your valuation. Can you change your assumptions and still get kind of the same answer, yes or no? Is this a good project or not? How sensitive is that decision to your assumptions? With real options, we're dealing with situations where the project can change drastically. You can think about starting a project and then just like abandoning it because it's no good, right? So that could actually be valuable. That option to walk away from a bad project is valuable. We haven't done anything like that here. What we've done is we just forecast our best guess and we just stick with it. But maybe it would make sense to do a 180 while you're in the middle of a project. And that would totally change your DCF analysis, but it could be very important. Another situation would be when you ramp up your investments. So for example, oil companies do exploration to see where to drill. So oil companies don't just say, I'm going to drill now. I'm going to go here, I'm going to go in this field, and I'm going to drill. Right? They do lots of little initial investments, and then they decide when to ramp up their drilling. Okay. Likewise, with pharmaceuticals, they spend a lot on R&D before they go through the FDA approval process. Right? You want to, the FDA approval process is very expensive, so you don't do that for every drug that you see. You do a lot of kind of smaller investments in R&D first, and then depending on how those pan out, then you decide to go through the FDA approval process. Okay, so these are cases where it would be very hard to just sit in one place and make a forecast and just say, okay, these are what I think is going to happen for the next 10 or 20 years based on, my best estimate. No, things are going to change too much. Maybe you go through the FDA approval process, or maybe you don't. Those are two wildly different scenarios, and you can't just kind of take the average of those two things. Okay. So DCF is not very suitable here. You need something else, something that allows for the flexibility to change your actions. And so that's what the real option model is going to do. Again, more on that after the first midterm. And finally, we want to talk about the discount rate. So far, we've just been given a discount rate. What we'll see is that the discount rate depends on decisions that the firm makes. If the company raises debt versus equity, that can affect the discount rate on its projects. And when the capital structure changes, when the mix of financing changes, that's going to also change the discount rate. Okay, so we need to have some tools to grapple formally with the discount rate. Okay. We'll talk about things called the alternative present value method and the weighted average cost of capital method after probably the second midterm even. Okay, so that's where we're at. We've come a long way, but these last 3 slides are really just trying to get you to take stock of where we are and to think about where we're going to be going after the first midterm.